Hello and welcome back to The Note. There's an awful lot of fixed asset investments going on in China, perhaps most spectacularly in the glorious new skyline that's taking shape in Shanghai. But that has been funded with an awful amount of credit, and that credit is now beginning to be cut back. Does that mean that China is at risk of a hard landing or perhaps even a true credit crisis? With me now to discuss this is Rafael Halpin, who is an analyst for the FT's premium research service on China, China Confidential. Raf, thanks very much for joining me today. Let's start by taking a look at the fundamentals going on here. What we're looking at here is short-term interest rates compared to credit growth. Why are we seeing these cutbacks?
Well, this chart illustrates nicely what is going on at the moment. So as the government's trying to rein in some of the riskiest elements of the shadow bank system, it's tightening things up in the interbank market, which is the source of much of that liquidity in the shadow banking system. So we've seen the 3-month Shibor rise, and at the same time, we've seen credit growth slow down.
Now, is there a risk that this is somewhat of a blunt instrument? And perhaps we could take a look at figures for the mortgage market, which you've also compiled. I mean, is there a danger that we'll just go from boom to bust rather than crimp this down gradually?
Sure. Well, our view is that China can rein in some of the riskiest elements in the shadow bank system, and it can rein in excessive credit growth without risking a hard landing. But there is going to be risks, and it is going to be a fairly rocky ride.
Now, how is it going to do that? It's notoriously difficult to let a bubble down gently.
That is true. That is true. And the biggest risk is to the investment-driven growth model, which China's been reliant on in the last few years. And we can see from this chart, for example, real estate, which is a big element of fixed asset investment. We can see as liquidity has tightened, home sales growth has slowed down. So we're looking here at the discount that mortgage lending rates normally achieve to the benchmark rate. That's fallen to pretty much zero in the fourth quarter of 2013. And at the same time, home sales growth has also fallen sharply.
But obviously there was quite considerable subsidies for people who wanted to buy houses for a long time if you were available.
They were able to get a mortgage below the benchmark rate, and that is now disappearing.
Okay, now let's take a look at the pattern of fixed asset investment across different provinces, and this is compared to their target. So as far as I can see, apart from Shanghai, even though we started with that, Shanghai seems to be a big exception to the norm. Most provinces are a long way below their targets for investment. Why is that?
Well, this is the really startling thing, and this is the clear indication of the fact that 2014 is going to be a very painful year for fixed asset investment. So you've got normally very bullish local governments coming out with far lower targets for fixed asset investment growth in 2014 than were achieved in 2013. So this chart compares the percentage points difference between the 2014 target and what they actually achieved in 2013.
So they really are pulling in their horns.
They are, yes.
And now let's take a look at what, as I understand, is a national priority, railways. Similarly here, it looks as though we're falling short of targets. Is that right?
That's right, yeah. And this again is alarming. Like you say, the rail network is arguably China's flagship infrastructure project. And yet it's cut its target for fixed asset investment spending in rail for 2014. That's down to 630 billion. From 660 billion last year in 2013. And the worrying thing is that it looks like China's going to miss its target, which was set for the 12th five-year plan, which was spending of 3.3 trillion. And what seems to be going on here, I think this is the key thing, that in this environment of slower credit growth, China's having to scale back a lot of its infrastructure plans. And that's very bad news for companies and miners, for example, commodity exporting nations who have been banking on that growth.
So in many ways, this is actually worse news for countries like Brazil or Chile that dig lots of metals out of the ground and send them to China than it may be for China itself. China is still trying to manage its slowdown, but that will perhaps have amplified effects elsewhere.
Yes.
Okay, Rafael. Well, that's not cheerful news, but I'm still glad to hear that you think we can avoid a crash. I think the bottom line on China, obviously, people are worried about it. You can tell that more perhaps from commodity prices than from the price of Chinese securities themselves. Whether there's a true crisis around, you're certainly right to be concerned that China's great demand for commodities is likely to continue falling.